less maintenance, endless amenities, and a 24/7 doorman? Who wouldn't want this? While there are many draws to condo living, there's also many things that you must consider if you plan on purchasing one and getting a mortgage. Now, this video isn't about why you shouldn't purchase a condo. Heck, my first purchase was a condo and I loved every minute of it. However, if you plan on purchasing one and getting a mortgage, there's 6 things that you need to know about. Number 1, you'll likely qualify for less. And that's because condos have something called Homeowners Association dues. This is just a monthly fee that's paid to the Homeowners Association in exchange for the amenities and other services that they provide to you. However, whenever we have Homeowners Association dues, they're going to count in your monthly payment, which means that the higher the HOA due, the less you'll be able to stretch your budget. Now, I have an entire in-depth video that walks you through all of the components of a monthly payment and how they impact your budget. So I'll reference you back to that video. But a quick recap would tell us that the components of a monthly payment are principal and interest, real estate taxes, homeowners insurance, mortgage insurance if you're putting less than 20% down or utilizing an FHA loan, and lastly, Homeowners Association dues if they apply. So in looking at all of the components of a monthly payment, the higher the HOA fees, the less it's gonna let us stretch our budget. Number 2, your homeowner's insurance will be cheaper than it would be if you were buying a single family home. And no, there's no catch to this. This is truly an advantage of buying a condo. And the reason for this is the HOA is going to carry a master insurance policy. This will cover things like the common areas as well as the structure of the building itself. When you're buying insurance on a single family home, you're paying for this. However, if you really think about it, this cost is going to be passed on to you in the monthly HOA dues. So yes, it might look cheaper on paper, but at the end of the day, you're paying for it one way or the other. Number 3, your interest rate is going to be higher compared to a single family home. And now this all comes down to risk. So if you think about this very logically, the end investor who's going to give you money to go purchase this condo has to not only worry about you defaulting on the loan, they have to worry if other individuals in the building default on their loan, and also if something happens that damages the building as a whole that will impact the value of your condo. So they build this risk in up front and they pass it to you in your interest rate. So how much higher could you expect your interest rate to be if you're buying a condo? It's hard to say without all of the information on the condo itself, as well as your buying profile, but at a minimum, expect to see 1/8 to 1/4% higher on your rate. Number 4, you'll have additional closing costs to pay for the required condominium documents. Now, I'll talk in depth about this in point number 6, but anytime you're getting a mortgage on a condo, there's going to be required documents that the lender must review in order to issue full approval. So how much do these documents cost? Well, it varies from association to association, but in the Chicagoland market where we do a lot of our business, it can be anywhere from $300 to $500. However, you always want to check with your specific association. Now, when it comes to these documents, you might see these on your loan estimate as an HOA certification on handling fee, HOA doc fee, something along those lines. So if you're currently in the middle of a purchase and you want to see how much you're paying for these, you can check the second page of your loan estimate. Number 5, certain condos you just simply will not be able to get a mortgage on. And the reason for this is because the HOA is likely on something called an ineligible or an excluded list. And the reason that they get this status is because of things like significant deferred maintenance. Perhaps there's pending litigation going on with the HOA, or maybe even that a single individual owns too many units in the building. So unfortunately, when this happens, this has nothing to do with you or your qualification as the buyer. This is solely on the HOA. But you may be saying, well, there's other types of loans than a conventional mortgage. What if I use an FHA loan or a VA loan? Well, the same comment. If the condo association is not FHA approved or VA approved, you're SOL. Again, nothing to do with you as the buyer. So when we run into these situations, what are our options? Option number 1, you try to get the HOA off of this ineligible status. However, in order to do this, it means that there must be correction of the reason that they wound up on that list or with that status in the first place. This is very unlikely to happen unless it's already happening behind the scenes. Other thing you could do is pay cash. However, if you're applying for a mortgage, you probably don't have that type of cash laying around. The third option is to try something called a non-QM or a non-qualified mortgage. Now, this won't help you out much if there's significant deferred maintenance. However, if the condo association is on that list because of something like pending litigation, perhaps there's too many units owned by a single owner, or maybe you even ran into that issue because the building's not yet complete, or too much of that building has commercial space relative to residential, a non-QM loan might be the right option for you. Number 6, condos require an extensive amount of information to be provided to the lender. And not only must it be provided, it must meet the requirements in order for that loan to get approved. So what exactly are these requirements? Well, there's safety, soundness, and structural integrity and habitability of the building or building themselves. They're looking for financial health of the HOA, and they're also looking for marketability of the HOA. And they do this through a combination of condominium questionnaires as well as required documents. So things like homeowners association board meeting minutes, things like structural and mechanical engineering reports, reserve studies, any upcoming or special assessments, just to name a few. So what types of things would have to come up in these questionnaires or within these condo docs that would result in the loan getting denied? As you can see, it has to be something pretty significant. So things like water or mold damage, significant deferred or outstanding maintenance that's required. These are things that unfortunately are completely outside of your control as the buyer. And to reiterate, I know I've said it before, you could have the perfect buying profile. You did nothing wrong. You meet all of the requirements as a buyer. But if the HOA is on one of these ineligible lists or has something that you see here, you simply will not be able to get that mortgage. As you can see, getting a mortgage on a condo is a little bit trickier than a single family home. And sometimes it is completely outside of your control and your lender's control whether that loan gets to the finish line. Now, if you have any questions about this, I'd love to connect further, and you can book a free consultation call by clicking the link in my bio. We'll see you back here on the next one. Please make sure you like, subscribe, and share the